$1 million home is now being sold as a starter home, and the people buying are not rich, they are just approved. This is exactly where the problem begins, because approval feels like validation. It feels like someone has checked the numbers and confirmed that this decision makes sense, even when the structure behind those numbers tells a very different story. If you've been looking at listings, if you've run these numbers even once, you've already felt that tension between what looks possible and what actually works. And if this already feels normal to you, that's the problem, because normal is no longer anchored to comfort. It's anchored to capacity, to how much you can carry without collapsing. The shift didn't happen all at once. That's why almost no one noticed it while it was happening, because prices moved gradually, expectations adjusted quietly, and over time the reaction to the number itself started to fade. Not because the number became reasonable, but because people adapted to it. The question changed from, is this expensive, to how do I make this work? And once that question changes, the decision is no longer about evaluation. It becomes about justification, about finding a way to fit yourself into a system that was never designed to be comfortable in the first place. Mark noticed it in a conversation he wasn't supposed to be listening to. He was sitting in a coffee shop where two people behind him were talking in low, controlled voices, not arguing, not excited, just carefully navigating a conclusion they had already reached. One of them said, technically we can afford it, and the pause that followed made it clear that technically was doing most of the work. A few seconds later, the number came out, just over $1 million, and there was no shock, no disbelief, no reaction that matched the scale of the decision. There was just quiet acceptance, like they had already crossed the line and were now trying to make it feel reasonable. That moment never shows up in the listing photos or the open house walkthrough. But it's the moment that actually defines the purchase, because $1 million used to represent space, flexibility, and margin, and now it represents access to something that used to be considered normal. The numbers work, but the life around them starts to bend. And that's the part nobody includes in the calculation when they're making the decision. If you're thinking about buying, this is you, because the process always starts the same way. You look at listings, you adjust your expectations, and eventually the number stops feeling extreme. It just becomes part of the process. And once that happens, the system takes over, because the system doesn't ask what's comfortable, it asks how much you can survive. The bank is designed to answer that question in the most efficient way possible. The bank approves the loan, not the lifestyle, and to understand what that actually means, you have to step out of the listing and into the math. Because the math doesn't care what feels normal. On a $1 million home, a 20% down payment is $200,000 in cash. The median household does not have $200,000. It is closer to $10,000, which means this is not a small gap that can be closed with better budgeting or more discipline. It's a completely different reality. Even if someone saves aggressively, putting aside 15% of their income every year, they are adding maybe $12,000 to $15,000 annually. This means it takes more than a decade to reach that down payment. And that assumes nothing goes wrong, no interruptions, no unexpected expenses, and no further increases in housing prices. None of these assumptions reflect how real life actually works. So people adjust, not because it's optimal, but because it's the only way forward. That adjustment usually means moving to a 10% down payment, which is still $100,000 up front, but it changes the structure of the loan in a way that most people underestimate. Now you're borrowing $900,000. And because you didn't put enough down, you're also paying private mortgage insurance, about $300 a month, not to protect yourself, but to protect the bank. This means you're paying extra simply because you didn't have enough capital to avoid paying it. This is where it breaks, because $8,000 a month is not a lifestyle expense, it is a financial system. To carry that system comfortably, you need an income of about $340,000 per year, which places you in roughly the top 10 to 15% of households. And yet far more people are buying into this. This means the majority of people entering this structure are not doing so comfortably. They're doing so at the edge of what they can sustain. High income doesn't fix this. It hides it, because the higher the income, the larger the commitments you can qualify for, and the system scales with you. You don't escape it by earning more. You expand inside it. This becomes clear when you look at the people who actually buy these homes. It's not just the ultra-wealthy. Some buyers are rolling equity from previous homes, carrying forward gains from a different market. Some are getting financial support from family. Some are high earners in industries that can support these numbers. But there's another group, and it's the one that matters most because it looks the most normal. The ones who technically qualify. The Harrisons are exactly where you would expect stability to begin. They are two working professionals in a high-cost city, earning $280,000 a year combined, with good jobs, strong credit, and consistent income. On paper, everything about their situation says this should work. They put 10% down on a $1 million home, and the process reinforced that belief at every step. The approval came through, the numbers checked out, and everyone around them treated it like a milestone. After taxes and retirement contributions, they take home about $14,000 a month. Their housing cost is about $8,150, which leaves them with roughly $5,850 for everything else. And this is where the illusion starts to break, because the rest of their life doesn't shrink just because housing expanded. They make $280,000 a year, and they still feel broke. Childcare alone takes about $2,200. At the end of the month, there's almost nothing left. Sometimes a few hundred, sometimes less. Transportation, including 2 cars, payments, insurance, and gas, takes another $1,200. And this is what the structure actually looks like in real life. Not as a spreadsheet, but as behavior. Groceries are about $1,200. She stands in the grocery store and puts something back, not because they can't afford it, but because she knows every decision now connects to everything else. He sits in the car before ordering food and checks the bank balance, not out of panic, but because the habit formed quietly and stayed. They talk about fixing the dishwasher, but the conversation doesn't go anywhere because they both know it can wait. Utilities and basic services add $600. Student loans take $700. Healthcare adds $400. Waiting becomes the default response to anything that isn't urgent. At that point, they're already spending more than they have left. They postpone a vacation without calling it a cancellation. They start avoiding conversations about the future, especially the ones that involve adding new costs or making changes, because they already know what the numbers would say if they ran them honestly. And then one night, it finally comes out, not in an argument, not in a dramatic moment, but in a quiet pause where there's nothing left to hide behind. Did we make a mistake? And neither of them answers fast enough. They didn't buy a house. They bought a payment. From the outside, everything looks right. The house is there. The neighborhood is right. The careers are stable. But internally, the experience is different because success without margin feels fragile. Every decision becomes connected. Every cost becomes part of a chain, and flexibility starts to disappear. The bank never evaluates this part because the bank evaluates whether you can make the payment, not what making that payment does to the rest of your life. And once you're inside that structure, the options start to narrow. Opportunities that require change become harder to act on. A job in another city is no longer just an opportunity. It's a calculation that includes selling costs, timing, rates, and risk. So people stay, not because they want to, but because leaving becomes complicated enough to avoid. And then the next pressure point appears. They start talking about a second child, casually at first, the way people test an idea before committing to it. But the moment they try to attach numbers to it, the conversation stops. Childcare doesn't increase slightly, it doubles. Costs don't adjust, they jump. The system that barely holds now no longer holds at all. This is the moment where the math stops working. Nothing about their income changed. Nothing about their effort changed. Only the structure they entered. And by the time you realize that you're already in it, you don't escape the system. You scale inside it. And by the time you realize that you're no longer deciding whether the house makes sense, you're figuring out how to make the structure hold. And that difference is subtle but critical because maintaining something is not the same as choosing it, even though it feels identical from the outside. Nothing breaks immediately. Nothing collapses. And that's exactly why the pressure is so difficult to identify at first, because everything continues to function. The payments go through, the routine stays intact, and from the outside, the life still looks like progress. But internally, the experience starts to change in ways that don't feel dramatic enough to question, only consistent enough to reshape how everything works. At first, it feels like control. You become more intentional, more aware, more disciplined with money, and that seems like a positive shift. You're tracking spending more closely. You're thinking through decisions more carefully, and you're aware of how everything connects. But the reason behind that awareness is different now, because every decision carries more weight than it used to. When a large portion of your income is already committed, every new expense is not just a choice. It's a trade-off. And over time, those trade-offs stop feeling like individual decisions and start feeling like a system you're operating inside. The numbers still work, but the life around them tightens. This is where most people tell themselves they're fine, because technically they are. The payments are being made, nothing is overdue, and nothing has failed. But financial stability isn't just about staying current. It's about having space left over after everything is covered. And that space is what disappears first. High income doesn't remove this pressure. It delays it. It hides it behind a layer of comfort that gradually thins as fixed costs expand. The Harrisons feel this shift long before they talk about it directly, because behavior changes faster than language. He checks the account balance before ordering food, not every time, but often enough that it becomes automatic. She stands in the grocery store comparing prices on things they used to buy without thinking, not because they can't afford them, but because every purchase now has a consequence that didn't exist before. They postpone fixing the dishwasher again, telling themselves it can wait, even though both of them know it will cost more later. They quietly remove a vacation from their calendar and replace it with something vague, something like we'll figure out next year, even though both of them understand what that really means. They start avoiding conversations about the future, especially the ones that require them to look beyond the current month, because projecting forward forces a level of honesty that breaks the narrative they built when they bought the house. The question that came up once, late at night, doesn't need to be repeated because the answer is already understood, even if it's never spoken again. They didn't buy comfort. They bought pressure. From the outside, nothing looks wrong. The house is there. The neighborhood is right. The careers are stable, and everything aligns with what success is supposed to look like. But internally, the experience is different because success without margin feels fragile. Every decision becomes connected. Every expense becomes part of chain. And flexibility, the ability to change direction when something shifts, starts to disappear. This is the cost that never appears in the approval process, because the approval process is not designed to measure how your life will feel. It is designed to measure whether you can continue making payments. The bank approves the loan, not the lifestyle. As time moves forward, the structure becomes more visible, not because it changes, but because everything around it does. It's 2031, and the Harrisons have been in the house for 5 years. The excitement that came with the purchase is gone, replaced by routine. The payment is still there, unchanged, but everything else has continued to move. Property taxes are no longer $900 a month. They are closer to $1,100. Insurance is no longer $450. It's closer to $600. Maintenance is no longer something they estimate. It's something they experience, and it doesn't arrive evenly. It comes in waves. 1 month, nothing happens. And then suddenly 3 things break at once, and each one demands attention, time, and money they don't have sitting unused. Their income has increased, but not in a way that changes the structure. They're earning more than they did 5 years ago, but everything costs more now as well. Childcare has shifted into school-related expenses, which are different but not lower. Transportation costs have increased. Healthcare remains unpredictable. The system they're operating inside has become more expensive in multiple ways at the same time. And because their largest cost is fixed, they have less flexibility to adapt to those changes. Their savings account still exists, but it no longer behaves like a buffer. It behaves like a temporary holding space. It builds slowly and drops quickly. Every time it reaches a level that feels stable, something pulls it back down. The roof now needs to be replaced, and the quote is $22,000. They don't have $22,000. The HVAC system fails one summer, and replacing it costs $12,000. They don't have $12,000 sitting and used either. They lie in bed at night doing quiet math, not urgent, not dramatic, but constant. The question is no longer whether they can afford the house today. It's whether they can continue to afford everything that comes with it. Same income, less progress. This is where the decision reveals itself as a structure, because what felt like progress at the beginning now defines the limits of what they can do next. A job opportunity appears in another city, and they consider it. But the conversation quickly turns into a calculation. Selling the house, paying transaction costs, entering a different rate environment, and hoping the timing works. It's not impossible, but it's complicated enough to hesitate. And hesitation turns into staying, not because they want to, but because leaving carries risk. The house that was supposed to provide stability now functions as an anchor because it holds them in place while also limiting their ability to adapt. This is not an isolated outcome. It's a pattern that shows up across households that look successful on the outside but operate under pressure on the inside. Less than 15% of households can comfortably afford a structure like this, but far more are living inside it. That gap is where the pressure comes from, because the system doesn't stop you when the numbers get tight. It allows you to continue as long as you can survive inside it. And that distinction changes everything, because it means the decision is not about what fits your life, it's about what you can carry without breaking. The system doesn't ask what's comfortable. It asks how much you can survive. And once you understand that, the entire structure looks different because it means you're not being evaluated on what makes sense for your life. You're being evaluated on how much obligation you can handle. They didn't buy a house. They bought a payment, and that realization doesn't arrive all at once. It builds slowly, showing up in small decisions, in quiet trade-offs, in moments that don't feel significant on their own, but collectively reshape how life feels inside the structure. Because this was never really about a $1 million house. It was about what that house represents now, and what it represents is a system that sells maximum obligation instead of comfortable living, a system where normal life is priced like a luxury product, and where affordability is defined by what you can technically qualify for, not what you can sustainably live with. You're not failing to afford the house. The system redefined what afford means, and it did it slowly enough that you never stop to question it, which is why the trap works, because by the time you see it clearly, you're already making decisions inside it, adjusting to it, and carrying it forward as if it were the only path available, even though it never actually was.